have a huge deck of slides. What we're going to do is have more of a discussion. So my business partner, Shakti, he is the founder and CEO of Ashland Green. And so Sugo Capital and Ashland Green, for those of you who are new to our community, we work together to acquire apartment complexes. And he's in Dallas. He lives in Dallas. His company is in Dallas. They're a vertically integrated operator. They now have about 170 people on their team. So it's no small outfit. And each of us have 30 plus apartment complexes that we've acquired. And Sugo Capital, we've exited, let's see, 4 now. I will let Shakti tell you his numbers. I think they're around 6 that they've exited. They average around 28% annualized return for their investors. And Sugo Capital, in our exits, we've averaged around 33% for our investors. Hi, Shakti. Good to have you here.
Hey, happy Friday. How are you, Sarah?
Oh my gosh. Happy Friday. Indeed. Indeed. I woke up this morning. My daughter came in. She's like, we don't have to go to school today, right? It's the weekend. I was like, no, one more day.
Kind of feels like a weekend. It's been a long week. How are you doing?
I'm doing great. I'm doing great.
Great to
I
see
was
you. I
just
love your.
introducing you in the topic. Say again.
I just want to talk about your sweater for this next hour.
Oh, yeah. Is that
I love your
fabulous?
sweater. Yeah,
It's
that's
it's
great.
got it's
It's
got
like a
fringe.
cape. It's fantastic. It's on
I'm
theme
casual
too.
today. Normally I'm in a button down and a blazer like you, and today I said, it's a sunny summer day over here in North San Francisco.
Nice.
Yeah. See, I was just telling everyone that today is not going to be like a presentation and we jam through slides. It's going to be more of a discussion.
Hmm.
So I'll kick it off and just say, why are we here today? So there's a lot that's changing in the economic landscape, and it's changing faster and faster. So, we had the experience years ago when we first got started in this industry that multifamily was fairly static. And one of the reasons I loved multifamily is because it was fairly static. So I felt it was really low on the emotional scale as far as an investment class or an asset. And things have changed, and they're changing faster and faster. So how often we look at data that tells us where we are in the market cycle, we get to do that several times a year instead of maybe once a year or once every 2 years, because the data markers are changing so quickly. Have you had that same experience where it's like it used to be very static and now it's changing like one quarter to the next and we have to be on our toes?
Yeah, no, I've been seeing my chiropractor on a regular basis because I have so much whiplash. Every week, the 10-year treasury, Trump is saying X, Y, and Z. We're going to war with this place. There's some politics issue. Crypto goes, something happens with crypto. I mean, the stock market does something, Tesla does something, Elon says something. It's just COVID, floods, and storms. And it seems like there's a black swan event every year right now. And, in this moment, we don't know what is going to break next. And everyone's saying that there's a soft landing and the Fed has inflation under control. But then we all are feeling something very different, right?
Right?
And
Yeah.
yeah. And so, I mean, something is going to break. It's really hard to figure out what it's going to be. Nobody can anticipate it. But I have this like low level anxiety that something is going to break. I don't know what it is.
Mhm.
But I guess that's the general feeling I feel, and it's exactly what you're talking about.
Yes, and so when I'm looking at making an investment and I'm looking at who I partner with, so this is more for the audience to hear, is I look for someone who thinks that way and then comes up with a backup plan for that. So, sometimes people are out there and they're just like, this is the best thing since sliced bread and it's always going to be wonderful. And I always look to partner with people who are realistic, like, sometimes there's good times, sometimes there's not so great times. And how do we pivot, adjust our buy sell cycles, and come up with backup plans for those times when it does get a little bit tighter? So, so that's why I really love partnering with Shakti, his team, Ashland Green, because they're very realistic. They look at data in order to make decisions, and it's not all this like pomp and circumstance. Let's just go, go, go. So I'm going to
Yeah.
preface it with that and then say, who's in this audience for you, Shakti? Looking at the names, we have several people who are current investors with Sugo Capital, with Ashland Green, and then probably about half of the folks are totally new. They haven't seen you before. They don't know who Ashland Green is. So if you could just take about 5 minutes to introduce yourself and your company and the way that you guys are vertically integrated, your experience and why Dallas and that sort of thing.
Yeah. Before I jump into that, I just want to react a little bit to the comment you made about being proactive and being solutions oriented. I did make the comments about whiplash, and that's completely true. This quote that's been resonating with me for the last year or so, and I've been saying this to myself and a lot of other people, is life is 10% of what happens to you and 90% of the way you react to it, right? Of course, there's going to be obstacles. It's investing and it's real estate and it's a volatile market, but I completely agree with you. At Ashland Green, we are constantly navigating those challenges and we're coming up with creative solutions, proactively communicating with our investors along the way to come up with, like you said, realistic solutions, pragmatic decisions, being patient to get to the other side of these, of these times. But a little bit about our company. We were founded by myself back in New York, back in 2016. And the name Ashland Green actually is it's a funny story. Comes from a street in Brooklyn, New York, where I was born, called Ashland Place. And it was in a neighborhood called Fort Greene. And it also happens to be the same corner where I bought my first investment property back in 2010.
Very
Anyways,
appropriate then.
yeah. So it was like the corner where I was born, and it was also the corner where I bought my first investment property. It was a distressed property that was taken over by the bank. And anyways, that was in 2010. The times today don't feel as dire. We're not seeing discounts that are 50% off. We're seeing discounts that are maybe 30% off. But it is a once in a decade buying opportunity right now. So we're laser focused on the next 4 quarters being one of these times where the next big 20,000, 30,000 unit operator is made. And I think the people that are active in this market for the next 4 quarters, and we can talk about why that's important later, are going to be the ones that people are going to look back and say, wow, you guys are investor geniuses. And it's not. It's about market timing in real estate. It's about the way you capitalize a deal. It's about the market you buy in, the submarket you buy in, and buying the timing has to be right, especially in real estate.
Yes.
But a little bit about our company, and I'll hand it back to you to kind of take the next part of the conversation. So we were founded in 2016. I was buying multifamily, smaller multifamily in New York. I saw an opportunity in the Sun Belt. I came, visited, and I was really impressed with a few different markets. I made offers in Atlanta. I made offers in Dallas. My offer in Dallas got accepted. And we bought a property here in 2017 in Denton, right next to Texas Women's University and University of North Texas. It was a really not great property. It was a flat roof and chiller deal, but we got a great basis on it. And we did the value add program and return of 20 for our investors. We kept buying through 2018 and 2019. I finally moved here, and during COVID started a property management company because I saw that the third party management company wasn't doing what I hired them to do, which is protect our investment, protect the investors, and ultimately help us generate our return. In value add, you have construction and you have property management, and then you have asset management and the investors. All of those parts, especially in our value add business, have got to be speaking with one another.
Yes, they do.
And I noticed that during COVID, like when the market's good, everyone's talking. It doesn't matter if people are talking to them. Everything's just going up.
Yeah.
And it's when, things like COVID happen or the freeze or right now where you see kind of who's swimming, with their shorts off, like Warren Buffett says, and you see all the things that aren't working in much more clarity. And I saw that during COVID, and that's what caused me to start the management company. And then about 6 months later, the Texas freeze happened and about 10% of our units went down. And again, I saw the dislocation and I said, well, I need to start a construction company. And so that was the kind of catalyst for those two divisions being launched. So we're vertically integrated. We have about 6,000 apartments, all here locally in DFW. Our office is here in Uptown. We have about 170 employees, 45 here at the corporate office. We don't have any virtual employees. So that number count is full-time employees that are here physically in DFW, 170. And we have a pretty robust investor relations team.
Yeah.
Alok, who's my brother-in-law, he's also our head of investor relations. Him and Sarah are very tight. They talk regularly. Same with Stacy and Alok. So it's been a great partnership. And I think Sarah, you bring a lot of great ideas to the table from, hey, have you thought about doing this program, or have you thought about this with your on-site teams? This has really worked well for us over here. And so I think it's been an invaluable partnership, not just for the capital introductions, but just, your background in asset management, understanding operations. It's been eye-opening. I enjoy our discussions and looking forward to continuing to learn from one another.
Yeah, it really has been great. So you guys, I started investing personally with Ashland Green in 2022, and I was really impressed with how professional they were. There's a lot of operators who are good at one piece of the pie, but not everything. And I found Ashland Green to be good at the whole pie. And so then I said, hey, this is great. Let's partner together. So in 2023, we acquired 4 complexes together. This year we've acquired 1. We have another one we just launched yesterday. So we'll hit on that just for like the last 5 minutes of today. And we have that investor presentation next week. So what is today? Today is really what I want to do is talk about the 2024 macroeconomic outlook and how that impacts multifamily. And, it'll kind of spindle off into how it impacts investing and your other investments as well. And I'd be very happy if folks use the chat. So in the chat, in the drop down, you can choose host and panelists, or you can choose everyone. And I'd love for it to be really interactive. Like I said, it's not completely formal, but we're going to go over the macroeconomic environment, dynamics that are at play in the multifamily sector. And we're going to start with where are we in the market cycle. So I'm going to bring up a graph in case some of you are not familiar with the market cycle of multifamily, since it's different than single family. There's a lot of new faces. We'll talk about job growth, how that's affecting multifamily, boomers, how that's affecting multifamily. And then really what we want to pull out of Shakti is what data is leading him to think that the next 3 to 6, 9, 12 months are really a great time of opportunity. We had some risks in 22 and 23. Are those still the same risks? Do we have different risks in 24? So that's what we're going to try to cover in the next 45 minutes. So let's start. I know it's a lot. We'll see what we can get to. But let's start with, I'm going to start with a market cycle chart, Shakti, and because it's a little different than single family, and I think people don't they don't always know what are the different things. Where are we in the market cycle? Is a good time to buy or sell? And the market cycle is in multifamily. It used to be, back in the beginning, it was like a 5 to 6 year cycle. What do you think that cycle, like a full cycle, is today? It seems like it's not quite 5 to 6 years from where we go from, point A back to point A. What do you think?
Yeah, it's feeling like it's 7 to 10 years. I think we went on a pretty good run, an extended run, probably from 2011-ish, kind of as maybe 2010 is kind of like the part where there's a recession, coming out of the recession in 10 and 11, all the way through kind of 2020 abruptly kind of interrupted that cycle. And then we had the Fed obviously respond. So like that period from kind of like March, April of 2020 through June of 2022, if we just sort of take that out, we're probably looking at a 7 to 10 year cycle. And I think right now we're obviously kind of in the last section of the curve where it's in that recession cycle. We're probably trending somewhere between hyper supply, given all the new deliveries coming on this year, which we can talk about specifically in DFW, and
Yeah.
the flip side of that is absorption. But I think we're sort of somewhere in the phase 3, and certainly on the real estate side with interest rates where we are in phase 4 right now.
Yeah, I would definitely agree. So the data that Shakti is talking about is vacancy rates or occupancy rates, and specifically in DFW, several years ago is closer to 95, but I think is it closer to like 90 or even like 87 right now as far as occupancy?
Yeah, I think occupancies are certainly softening for us. We're not getting rent growth, lease trade outs like we were. We're
Yeah.
either flat or maybe, sub 3% on
Mm-hmm.
our renewal increases and our new leases.
Mm-hmm.
And we're also in the middle of leasing season right now. So we're being as aggressive as we possibly can be to try to
Mm-hmm.
push to get to a 94% occupancy by the end of July, first half of August. But then we completely pull back September through February on rents. We keep them flat. There has been some more less seasonality in prior years, but kind of given where supply is right now, we're just going to hold occupancy through the late fall and winter months. But can I share a graph real quick, Sarah, just for 1 second?
Totally. Yeah. Let me stop sharing.
Enable me to share this. I think it's important on the supply side as we're talking about DFW in particular. Um, Let me just share this. Can you guys see my screen right now, Sarah?
Yes.
Okay, let me see if I can make it bigger. How's that? Can you see okay?
Yes. It's great.
Okay, so this is basically, addressing different submarkets and different MSAs across the country, across the Sun Belt in particular. There are some outside of the Sun Belt in the Midwest, but you can see on the y-axis, it's showing the percentage of inventory growth. So Huntsville, Alabama, for example, their inventory is growing by nearly 30% over the next 12 months or so. Now, if you look at the absorption, they're only going to be absorbing around 8 to 9,000 units. And so what you're going to see in Huntsville, Alabama, relative to their supply is probably rent decreases. The same thing you're going to see in Austin right now. We're also seeing that in Phoenix. We're seeing negative rent growth.
Yeah.
And if you look at Dallas, it's an outlier. And so much of the reason why I moved to Dallas is because all the jobs are moving here and all the people are moving here. So you can see in DFW, we have about 850,000 apartments here, and we have about 70,000 units that are being added, or 52,000, give or take. But it's only about an 8 to 9% increase in our inventory. But look at our demand. Our demand is going to absorb this inventory probably in the next 12 months or so. So deliveries relative to absorption, DFW is kind of in a class of its own. So what does that mean for investment over the next 1 to 2 years? What we're going to see is, like I mentioned, you're going to see softer occupancy. You're going to see very limited rent growth over the next 12 to 14 months. But starting in the back half of 2025, we're anticipating all of that supply to be absorbed. And right now, if you look at new construction, there's nothing that's being built. Interest rates are too high. The cost of labor is very high. Supply is very high. Like if we look at this chart here, you can see construction cost trends. Look at lumber, look at steel, look at concrete, look at aluminum. We're talking anywhere from 16 to 64% increases.
Oh my goodness. So how has that affected the CapEx projects that you have on your current properties?
So we're obviously working with vendors that are sourcing materials from all over the world. We actually haven't been impacted. In fact, some of our pricing has gone down a little bit. There was a issue. This is all a lot for new construction. These are impacting new construction more so than existing. We were having a little bit of an issue with appliances and cabinets about a year and a half ago, but now, since not a lot is being built, there is much more available supply for us in terms of product. But this is for new construction. You can see the increases. And then you look at the cost of labor and look at the elevated pricing just over the last 4 or 5 years. And because of this, construction costs are up 25 to 50%, and we're just not seeing a lot. On top of this, you're seeing construction financing be elevated to almost 9% with where rates are. So you're not seeing a lot being built. And you see the new construction here is beginning to fall in 2023 and 2024, which means once this supply gets absorbed, which is going to be the fastest in the country here in DFW, you're going to start seeing rent growth. And this is very similar happened in 2014 in Phoenix. Nobody wanted to build anything after 2008 in Phoenix, right? A lot of single family homes, multifamily was purchased and absorbed. And then in 2014, 2015, cap rates started compressing. People started looking around and saying, wait a second, there's no new product to move into. And then you saw rent growth almost go hyperbolic for a couple of years in Maricopa County. And then cap rates compress pretty severely. I don't think we're going to see that type of growth at the back of 25, but I think we're going to start seeing 5 to 7% rent growth even more on the existing supply that's there.
So is that why you think it's such a good time to buy in 24 in order to complete all the renovations and the CapEx so that we're poised to take advantage of the potential 2025 rent growth surge?
Yeah, I think I'm trying to look for another slide where it talks about loan maturities, but if you kind of think
Oh
about,
yeah. I've sent
yeah,
some out to the community around that. That is, I mean, it is really impactful to see. Yeah.
yeah, there's another slide that I don't have on this deck, but it basically shows how many loan maturities are in 2024 and 2025. And the simple way to think about that is if you look at where interest rates were 3 years ago in 2021, right around this time, the Fed began aggressively cutting rates in the back half of 2020 and really 2021. And interest rates were, 8 basis points, and then you had a spread on top of that. So what ended up happening is a lot of investors started taking bridge loans in 2021, 2022. So if you look at when the Fed started cutting rates post-COVID, and you look at what happened with the market, it was the most transaction volume in a 12-month period from June of 2021 to June of 2022. And those bridge loans are 3-year loans and 2 one-year extensions. So if you just do the math very roughly, those deals that were contracted in March or April of 2021 probably closed in July or August of 2021. And that continued all the way through June of 2022. So all those expirations, those 3-year terms are coming up right now.
Yep.
And
We have
so,
some of those.
of course we do. Yeah,
Yep.
of course. If you were active in the market in the back half of 21 and the first half of 2022, 90% chances you have a bridge loan and it's coming due.
Yep.
So what's happening is sponsors are being sent letters by their lenders and saying, you don't qualify for an extension. If you want to qualify for an extension, we need you to pay the loan down by $6 million, $8 million. And otherwise, you have to refinance us out, which is a cash in refi, or you have to sell the property. And we don't really care about the value of your equity. We just have a 3-year bridge loan with you and we need our money back, right? And you're no longer qualifying for the extension.
Yeah.
So the last, I would say 30 to 30 days, Sarah, a majority of the deals that we've underwritten are full equity wipes because they're forced sales, right?
Can you explain what that means?
Yeah, so we
Kind of
looked
more
at a
layman's
deal.
terms.
Yeah, we looked at a deal in Garland last week, including the deal we're looking at next week. That deal was bought for I think $6 million, $7 million more than what we're currently about to buy it for.
Yes.
Yeah.
So
And so
equity wipe means those who have ownership would not receive anything at the sale.
correct. Yes, exactly. Yeah.
That's pretty dire. And I want to bring that forward because it's really common. So a lot of you who are here and maybe you're new to multifamily and you might be hearing like, oh my gosh, I'm not getting my distributions. There's capital calls. They're selling it and we're not getting our capital back. That is happening. And it's, I try to be realistic. Like, it's not that they were bad sponsors back in 2021. There's a lot of really great sponsors and operators who are having that experience. It's not that they did something out of negligence. It's that the world changed drastically. And some people didn't make those choices to have bridge loans and some did. So it was, it wasn't, no one had a crystal ball that this was going to happen. That was one of the risks of the past. And then now I'm going to pause because I'm not going to go anywhere because it looks like you want to go right to these red boxes. So I'll let you take it.
Well, it's exactly what you're saying, Sarah. It's like, look at the price difference from 2018, right? 2019 up to 140 a door.
So this is price per unit, meaning like if you have one apartment unit, what would it cost if you just kind of prorated it, right?
Exactly. Yeah. So this is 163,000. And then look at this hyperbolic growth, 189, right?
Yeah.
This is the Fed cuts rates super aggressively after COVID. And prices start going, parabolic. You go from a 5 cap to a 4.2, and then 2022, it peaks and goes to a 4 cap, 193 per door. And so that's what people were paying for it. And now these bridge loans are coming due in 2024 and unfortunately the cap rates are 5.5 cap and 155 a door. So you're buying the deal for 193 a door. You're probably putting 10 to 12,000, maybe $20,000 of CapEx and closing costs into the deal. So you're all in at like 220 a door and you're selling for 155, which may not even be the balance of the debt. And so that's what's happening right now. And
Yeah,
it's starting right now. And literally we're seeing it real time, Sarah, just in the last 30 days.
totally.
We've been waiting for this opportunity for a while.
A lot
And
of
then,
people thought it was going to come last year.
yeah,
But I think that what happened last year is that you could do some capital calls, you could infuse some other capital to kind of get through the hump. But I think the properties that are coming due now for extension, like everybody's dried up. Trying to do capital calls now is hard. Everyone's already been capital called. It's the capital is holding back. And yeah, so it's really different. So the choice that these operators have is to sell at a complete loss of capital for investors, or to basically just have the bank take it. So it is, yeah, it's really quite amazing, the opportunity that it presents to folks that are prepared to scale and take these on. Someone asked, and this, I'm glad that you asked, Kenneth, because a lot of people probably have the same question. Shakti, can you explain what is a cap rate?
Yes.
And do you like high or low cap rates? What does it mean?
Yeah. So for those of you that maybe are familiar with like a multiples of, it's basically a way of looking at a stream of cash flow. And you're basically taking your net operating income, which is profit minus expenses, right? So that's basically your net income, and you divide it by a cap rate. So as owners and operators, we can only control NOI to a certain extent. We can't control what rents are in the market and occupancy, but we can generally, through our operational capabilities, we can control net income, right? We can lower expenses and we can do our value add premiums. We can add other income items. We can manage that P&L, that profit and loss statement, very tightly, and we can control NOI. And so what a cap rate is basically it's a market determined rate of return that is appropriate for an asset class. So for example, if you're investing right now in a risk-free 10-year treasury, you may be getting a 4.5 or 4.8% rate. If you put it in a money market, you may get 5%, right? Right now, cap rates in multifamily are 5.5%. So that's what generally they say is a 5.5% cap rate. So you take your NOI, your net operating income, and you divide it by 0.055, and that's generally the price that the asset costs. So if you got a low cap rate and you same exact numerator, let's say it's $1 million, you divide it by 0.055. Let's just do that math. You guys can join me if you want to do some math. So just take $1 million stream of income. That's your NOI. That's the 12 months of NOI. And you divide it by 0.055. That asset is worth $18 million at a 5.5 cap. Okay. Let's say that same stream of income, you do nothing to the property. We buy it today. We operate it exactly as the prior owner operated it. And we go to sell it in 3 years. Again, it's $1 million, no change in NOI, but the cap rate is now 0.04. That $18 million asset is now worth $25 million. So that's the power of what we call cap rate compression. So we want cap rates to go low, but we don't hope for that. What we're hoping for is that we can increase the NOI, and then hopefully through some, through the market, and there are expected reductions coming in cap rates as the Fed lowers their rates. But if we can push NOI, i.e. the numerator, up, and then the market takes the cap rate down, it's a much bigger return for our investors. I don't know if I explained that well, Sarah.
I think so. It increases. So bringing net operating income up, and if the market cap rate, which is not in your control, goes down, which we're thinking it will, then that creates a situation where the sale price in 5-7 years when you go to sell it is higher. So
Right.
then we all make more money on the appreciation on the backside.
Exactly.
Um,
Get really excited when I talk about cap rates.
yeah. So So the newest, I don't want to dive into the whole property, but the property that we just got under contract, the cap rate is 6%. So is that a good thing, an exciting thing? It's higher than what you showed. So is that good or bad?
That's good. We want to buy at high cap rates and we
Yeah.
want to sell. Maybe I'll share my screen again and sell at low cap rates. And
Yeah.
if you guys ask Sarah, you can just ask her on the call. Let's put her on the spot.
Ah.
Okay. The best deal you ever did, Sarah. What was the cap rate when you bought it?
Oh, well, you put me on the spot and I will fail because I don't remember.
Okay. What year was it? How about that when you bought it?
Bought it in 2020 and sold in 2022.
Okay. So you probably bought it at a
And it was
five cap.
South Carolina.
Yeah. So Sarah bought a deal on average, if you look at 2020, at a five cap. I'm sure she got a better deal because she gets great deals. So she bought it at a five cap. That's where the market was. And she sold it at a four cap. That ultimately, guys, is you ask any real estate investor, what's the best deal you did? They bought at a high cap rate.
Yeah.
They sold at a low cap rate. It's not, people try to make real estate investing complicated. And we're buying today at 5.5 caps. We didn't buy at 5.5 caps since 2018, where it was a 5.6 cap. And all we're going to do is operate extremely tightly. And maybe the Fed doesn't cut rates this year. Maybe they only have one cut next year, but we put together 5-year business plans. And there are some cuts that are projected. And maybe we use a conservative exit for our cap rate. Maybe we don't assume 5.5. Maybe we don't assume 4.5. Maybe we assume 5.25 for our exit cap rate in 5 years. But that's ultimately the best deals. You buy them at a high cap rate and you sell them at a lower cap rate.
Yeah, we purchased throughout 2022, we purchased 4 properties in South Carolina, and then we bundled them together and sold them. It was about 1,000 unit bundle that we sold in 2022. So the cap rates compressed, which was fabulous. And it was like just before all the rate increases were being announced. We sold it in June before the rates went up, and we sold it as a bundle. So it was like, yeah, investors got like 30 to 40% annualized returns in 2 years. It was like amazing, but it wasn't necessarily us. It was timing the market, which is exactly right.
And that's a big part of this, right? You got to buy in the right cycle. And you look at everyone who made a ton of money in the last cycle, they started earlier in the cycle. 2010, 2011, 2012, even 2017, 18, 19 were good years to get in, right? It was just a unforeseen kind of sort of, how do you want to say it? Unforeseen kind of result of the Treasury pumping in, $2 trillion into the economy, and being nervous about COVID, that the Fed started getting involved in cutting rates. And that's when all of our home prices doubled and money was free. And it was different. Now, we don't hope for that again. We hope for it, but we don't really base when you guys come next week to the presentation, you'll see our analysis does not assume that we're going to buy it at a 5.5 and sell at a 4 cap. Right. I think we're saying that we're going to buy it we're buying it actually at a 6, which is an above market cap rate, which is a good thing if you're a buyer. And I think in our assumptions, we're exiting at like 5.25 or 5.5, which is actually much higher than what the projection is in 5 years. And we're going to share a slide next week that will tell you in 5 years, here's what the projected cap rate is. And so we'll show you how conservative we're being relative to what the projection is in 5 years.
And there's some more questions around cap rate. So a couple more points. People want to know, okay, so if you're not in control of cap rates, what affects cap rates? And I think you were going to dive into that in a second. And then someone's saying, I look for syndicators to not change cap rate throughout the term. So if you buy at a 5 or you buy at a 6, do you assume that you sell it at a 5 or 6? I don't want to see a lower cap rate. If that happens, great, but I don't want to depend on the cap rate compression. And I think that's exactly what Shakti was saying, is that when they do their financial modeling, they hope for it, but they don't plan for it, right?
Exactly, yeah. And what was the first question, Sarah? I want to answer that one.
Yeah, so if the operators don't control the cap rate, what does influence or change the cap rate? And so I think you were going to go into, like what the Fed is, or maybe you weren't, but it sounded like it. what the Fed has been doing. The rate has projected for 2024 and how that's going to influence things.
Yeah. So a cap rate is basically a risk-adjusted return. And so different asset classes have different cap rates. If you go to office right now, maybe you can buy a 12 cap or a 10 cap or a 13 cap because that is the
Nobody
return.
wants it.
Yeah, exactly. Nobody wants it. It's got physical obsolescence. People are working remote, working from home, and the need to have large office towers in downtown San Francisco is not necessary. Nobody wants to be in those. So they're trying to figure out ways to repurpose and make them into multifamily. Why do they want to make them into multifamily? Because there's a huge demand for multifamily. There's a shortage of housing. And there's always liquidity in our marketplace because we have Fannie Mae and Freddie Mac, which are two quasi-governmental agencies that are required by the government to exist to provide stability to the housing market. No other real estate asset class has Fannie and Freddie. So even in a recession, multifamily always performs because there's liquidity in the capital markets. But a cap rate basically is determined off of the risk-free rate. So if you can invest risk-free in a treasury and get 4.5%, there has to be some premium for the risk that you're taking by investing in an Ashland Green deal and a Sugo Capital deal, right? There is more risk when you invest in real estate versus a AAA rated treasury. And so there's a risk premium associated with that. So ultimately, the market determines what a cap rate is, but the market determines it based on what Fed policy is and what the cost of capital is in the market. So when money was free back in 2021 or virtually free, cap rates went down to 3% because you could get you guys remember in 2020, 2021, 2022, you guys were getting 1% on your savings account. Do you remember that, Sarah?
Well, I don't put any money in a savings account, but I remember it happening to other people. But I also remember people taking, loans out at like 2.5% and then investing in the Sugo cash flow fund, which was giving 12%. And they're like, this is amazing.
Right. Exactly. And so if you want, you can get, 1% if you put it in the bank, or you could go invest in multifamily and get, a slightly higher risk adjusted premium. So that's kind of the thinking and how kind of cap rates are determined. It's really based off of what a risk-free rate is. And then there's a premium, a risk-adjusted premium added depending on the type of asset class. And generally, multifamily stays much lower than the other asset classes because of the liquidity in the marketplace provided by the US government, and also because of just the nature of the fact that it's everyone needs a place to live. And you can't change that. So that's a little background on cap rates.
A little background. That was a lot of background on cap rates. So I hope that answers all the cap rate questions. Awesome. Okay. So I want to talk about two other things. One is, let's start with jobs. So, in real estate, you want to look at population. So especially in apartment complexes, you want to look at population. Because if, there's 1,000 people, 1,000 people need a place to live. And if you're supplying a place to live, that makes common sense, right? But where do people live? So they live close to where the jobs are. Even if people have remote jobs, they often tend to live in places where there are other jobs because it is a larger community. It is a hub. And so, in the US, there's been different trends, but I'd like to know from your perspective, because you're in Dallas, you've been in Dallas, what have you seen in the job market? Because this is like the first thing. It's the ripple effect from the jobs. It's jobs, and then that tells you population and household and occupancy and rent. But really, the jobs are the first domino, right? So what have you seen?
So it's obviously Dallas is the number one corporate relocations in the country. We have had consistently the largest number of inbound migrations from corporations. And like you said, Sarah, the cascading effect is people. And when you have people, you need apartments and homes.
Yeah.
And so we've been consistently the number one corporate relocation destination for companies for the last several years. During COVID, number one inbound migrations, and it's been consistent every year since then. But the different thing about Dallas from a Phoenix or an Atlanta is the type of jobs that we're attracting. It's not just a blue collar worker or a back office type of worker making 40,000 or doing a sales job. This is, generally a more upwardly mobile 75,000 to 150,000 technology worker. We have some huge companies here. Companies are continuing to relocate from your home state of California, my home state of California, and also my temporary state for 10 years, which was New York, because we're landlord friendly. We don't have state taxes. It's a great place to raise kids. The housing is relatively affordable. Why wouldn't someone want to live in DFW when it's top 10 in terms of affordability, when things are becoming so expensive? So there's a lot of considerations that corporations have when they choose where they should be moving. And part of it is, where can our employee base live and still afford to live? And where is there an expansive amount of housing available? And DFW checks so many boxes, and that's why we're such a popular inbound destination.
And it was a couple of weeks ago, you were having a webinar with someone from Marcus and Millichap, and I believe you're on the advisory board at Marcus and Millichap, and they recently rated, so they're independent research, right? And they recently rated DFW, Dallas, the #1 city for investing in 2024. Is all that information correct, or you want to expand on any of that?
Yeah, it's right here. So Marcus and Millichap, first time. Typically, Sarah, they have not done this. CBRE has rated us the #1 investment market for apartments over the last 3 years. Every single year, CBRE has done it. And John Chang, who's the head economist at Marcus and Millichap, and I see him at NMHC every single year. First question I ask him is, where is DFW ranked? And he tells me it's #6, it's #5. This year in January, he told me, I got great news for you, Shakti. It's #1 this year. And I said, oh my God, like, what changed? Why did finally Marcus and Millichap rate us #1? And why were you, because he's instrumental in that he has a whole team of researchers that help. And he told me it was because of supply. Typically, historically, Dallas has always loved to build, and other submarkets in the Sun Belt and across the country, they've liked to build, but not as much as Dallas, right? But this year, all of those other places have so much inventory coming on the market that they can't absorb. And this is the first time where Dallas has, relative to their existing inventory, a small percentage, maybe 8% of their inventory, maybe a little bit less, coming to market, but we have the ability to absorb it faster than anyone else. So that is why Dallas has always been in the top 5 or 6, but really this year has gone to #1 because our inventory and our absorption relative to our inventory. So that's why we're going to see positive rent growth. And when they're looking at these different metros and making, the rankings, they're looking at, what is occupancy going to look like? What is rent growth going to look like? Those are the 2 biggest things that they look at when they're ranking these MSAs. And that's why we were #1 this year. And so I had John come on and speak to the investors about a month or 2 ago. And I know you enjoyed that, Sarah. I still need to make that introduction with you and John so you can get some FaceTime with him.
Yeah, I think that was awesome. And it's always great to hear because, so this is for the audience. Whoever you're listening to, you have to know their goal in telling you information. So obviously, Shakti and I, whether conscious or unconscious, like, we're doing business in a certain way and we want you guys to come along with us. So we have some bias, right? But if you look at a third party like Marcus and Millichap and their independent research tells you something, they have no reason to to tell you information one way or the other besides it being very factual. So that's why it's always really great to look at the data produced by third parties who don't know you, have no incentive to tell you things are great or things are not great. Go ahead.
No, and we're seeing that real time. When these things come out, Sarah, they're great because we own and operate in these markets, but it also brings a lot of competition, right? I mean, everyone across the globe is reading this report and they're making their allocation decisions, at the beginning of the year. Like, where do they want to invest? What markets do they want to target, right? And we've had very, very specific focus over the last 5 years, or I guess since 2017, only being in DFW. And so I think that's been a huge advantage for us because we were able to build those relationships. We own 21 communities here in the Metroplex, soon to be 2022. So whenever a deal comes on the market, the first call that brokers make is, let's call Ashland Green. We're always in the top 3 because we own nearby, and that's
Yeah,
great for our investors.
I love it. I wanted to point out this resource for investors. So it's just marcusmillichap.com. And once you're in here, you can click on Gain Insights. And then whatever market you're looking at investing in. So say it's not Dallas, you can put anything in here. But when you type Dallas, okay, of course it's not doing it right now. It was pre-filling for me earlier. It would pre-fill with the type of, like, do you want Dallas multifamily? Do you want Dallas office? Do you want Dallas self-storage? Here it is, Dallas hospitality. So you can go and you can find this information yourself and study on it. Dallas, office, like Shakti was saying, nobody wants it. What do those numbers look like? So you can take what you hear from different, operators and out in the news as well, and come to a place like Marcus and Millichap and look at the data in order to make investment decisions for yourself.
Somebody had a question to see if these were only for multifamily. Yes, that is just multifamily rankings. Good question.
Yeah. All right, I'm just scanning. Okay. I think we got all those answers. So I want to take a look at, we kind of talked about it when we were looking at the cap raise, when we were discussing the last few years. 2022 to today, there's been a lot of, basically I see there have been 3 main risks. There's been a lot of risks. There's been a lot of changes that have created a situation where our properties are getting less and less cash flow. And so the volume that we've been purchasing and acquiring is lower and lower because we're much tighter on our criteria when we're underwriting, right? And so the top 3 things that have put our current portfolio at risk are the interest rates going up. So we already talked about that. Interest rates went up, and loan to value, what we were being given instead of 70% loan to value, 50% loan to value. That created a compression of the profitability. Number 2 are taxes. And so a lot of our properties in Dallas, the property taxes went up, and then insurance rates tripled in some of the markets and on several of our properties. And so that really created a situation where, like, okay, we just ate up all the cash flow from those 3 things. We did some original underwriting, and we did not expect those things to change. So I want to talk about, do you think those 3 things are still factors that we need to hyper pay attention to in our acquisitions today? And what do you think those 3 things are going to do in the next 3, 4, 5 years during the hold period of what we're acquiring right now?
Yeah, it's a great question. I think the number one thing is obviously, like you said, interest rates. That is a function of inflation and what the Fed is doing. So, just in the last 3 weeks, we've gotten some data in last Friday on the jobs numbers. Those came in, I'll say better, but like generally for the economy worse because there was fewer jobs created, which is now it's considered, from our vantage point, a good thing. It means that the labor market's cooling off. And we saw the 10-year treasury go down by 20 basis points. For those that don't know, 1% equals 100 basis points. So 20 basis point is 0.2 of 0.2%. Okay. So that's number one. And last week, or this week, I guess on Wednesday, we got an inflation report that came in slightly, showed a slight cooling. And then the treasury market came in a little bit. So interest rates, in terms of what the Fed is setting in the secured overnight financing rate, SOFR, and the Fed funds rate is what they set. That determines the short end of the curve, which is short-term interest rates. And then, of course, the treasury market reacts and shapes their expectations about the future. And that's where kind of the longer parts of the curve, the 5-year, the 7-year, and the 10-year durations are determined. So number one thing we're looking at is the future of inflation. And we're listening to what the Fed is saying very carefully, because as soon as there's a rate cut, that means the cost of capital will go down and cap rates will come down. So that is the most important thing. Your mortgage on floating rate debt will also come down. And mathematically, that is by far the largest expense that we have. But numbers, so we're watching that very carefully. There is an expectation that in the future, there are going to be rate cuts, but it's very data driven. And like we've talked about, we don't know what the next black swan event is going to be. But if there is a black swan event and something in the economy breaks, the Fed will break glass in case of emergency very quickly, because they have two mandates: is to, one, keep unemployment at a certain level, and the number two is to keep inflation at or around 2%. If one of those things start getting out of whack, the Fed uses interest rate policy, monetary policy, to change the course of what the economy is doing. So that's number one thing we're looking at. Number two and number three are taxes and insurance. You can see in this chart what's happened to taxes. We're talking about a 40% increase on taxes.
That's
And
huge.
Dallas specifically is off the charts when it comes
Yeah.
to taxes. $400 per month per unit. Okay. Same thing with insurance. We're not Florida. We're not Houston. We're not on a floodplain. We're not at risk of flooding, but we still have hailstorms here. And you can see we're off the charts on insurance as well. So this is up 120%. We just got our renewal in last week for our entire portfolio. It renews on, I think May 10th, it renews. And we were flat to slightly negative across our portfolio on insurance, which was a huge win. And then same thing with property taxes. Property taxes are decided in January it's decided in basically the beginning of the year. So the 2024 taxes are picked using 2023 data in January 2024. So last year we actually saw flat to a slight increase in property taxes, and we're assuming, since 2023 was so slow, and since 2024 is going to be a year where, rents are flat, occupancies are down, prices are down, all that data is going to get pulled in January 2025. So we're probably going to see property taxes flat for the next several years. We're also seeing millage rates go down, which is what the county uses to calculate the value of your property. It's called a millage rate. We can talk about that later, do a deeper dive, but we are seeing flat to slightly negative this year, and we anticipate the same in next year. But once prices start picking back up, you can see that this chart obviously tracks also with prices, because it costs more to insure more expensive apartments, and the property taxes are higher for more expensive apartments. So as we see the prices come down right now, if you continue this trend over the next 3 or 4 years, you'll see either flat or lower property taxes and insurance.
Hopefully. So if I'm hearing you correctly, and I see some people are asking this in the chat, so these things have been going up. These are expenses. This has, reduced the amount of cash flow we've seen in a lot of our properties. And when I say I don't mean that ours together. It means like Sugo stuff that doesn't have to do with Ashland Green has been increasing as well. But you think that these are going to flatten over the next several years, and is that how you do your underwriting for the properties you're acquiring this year?
No, great question. With the cap rates, we are using a forward projection of what the expectation is for cap rates in the future.
Yeah.
And we're looking.
For the interest rates and for the tax rates, what are your assumptions in your underwriting?
So I was talking about cap rates. And so we're using future cap rates as what our barometer is to determine what our exit cap rate is.
Yes.
I think somebody in the chat said, well, we don't want to look at deals where cap rates are getting lower. And we'll show a chart next week where we'll show you what the projection is. And then you can decide whether you think our cap rate for the exit is appropriate. But in terms of what we're doing on interest rates, we're using an expectation of what the Fed is forecasting for the future.
Okay.
And then we're buying interest rate caps. And then for property taxes and insurance, our models actually increase expenses by 3%, and it increases property taxes by 5%. So, we do think it's going to be less than that, but our model is a bit more conservative.
And I think that's great. And that's why so many of our investors love the properties and the underwriting that you present, because you're not saying so for those of you who aren't familiar with the term underwriting, it's basically your 5-year business plan in number format. What are your assumptions? So you have your income, you have your expenses. So some folks could say, look, I think these are going to come down. So over the next 4 years, my expenses are going to come down. Ashland Green in their financial projections say, we expect these expenses to go up. And look, we still are projecting that investors can receive, 18 to 20% annualized return. So if they do go down, then the returns are even better. So I love conservative underwriting because it's more like preparing for, not for the worst, but preparing for, not the best thing to happen. And if the best thing happens, it's even better. We have 5 minutes left. So what I'd like to do is share my screen and just show everyone what we're going to talk about next week. And I think it's really cool because Sugo Capital, as far as real estate, we have always done multifamily apartment buildings, value add. And one time we do have one development project in Phoenix. So that's the one non-value add that we have, but it's still apartments. And so when you guys brought this next deal to me and you said, hey, look what we got, I was like, what? It's beautiful. They're beautiful townhomes. It's a community, 144 townhomes. And the really cool thing is that they're all, even though they're townhomes, they're all very independent. So they have their own garage, their own washer dryer, individually metered. So it's the economies of scale of multifamily and the lower risk of multifamily, but in a situation where the exit, they can be sold to someone who wants to turn them into condos and sell them individually and that sort of thing. So it has a lot going on for it. So I'm just going to bring it up and show everyone. And if Shakti, if you want to just, do like a couple minutes and just talk about the property while I show folks how they can get access to it.
Yeah, so this is a deal that was brought to us by a broker relationship. It was purchased by the current seller for 26.5 million, and they put about 2.5, 3 million into it. So they're all into the deal for somewhere between 28.5 and 29 million. Obviously they bought it 2021, 2022 timeframe, end of 21, beginning of 2022. There's a partnership split. And this is the only asset that this group out of Canada owns here in DFW. They're using third-party management to operate the deal. I think they've been doing a decent job, but they've done a lot of the exterior work. The pool area is decked. The branding is good. We're not going to need to change that. So a lot of the things that we would normally do on a property are already done here. Like Sarah mentioned, it's a townhome deal. So you can see in that first picture, you see those high ceilings. It's got washer dryer connections in every single unit. It's got 9-foot ceilings. And the biggest amenity in DFW is attached parking. So every single unit either has a single car parking garage or a 2-car parking garage. And so if you think about the most desired amenities in DFW, it's washer dryer connections and it's attached garages. This property was built in the 1980s, but it was built, like Sarah said, to condo spec, which means that all the utilities are billed directly from the city to the resident. So the resident doesn't pay us and then we do like a bill back, or typically a lot of our other properties, we receive the bill from the city and then we pay the bill and then we do what's called RUBS bill back. We bill back the residents. This is directly metered directly with the city. So they're truly condo-like townhomes. And it's because it's an 80s deal, but it has all of the characteristics of a 90s/early 2000s deal. We're buying it at a very low basis, and we're renovating a majority of the units. 135 of the 144 units have not been renovated, and we're using about a $260 rent increase on those 135 units that we're renovating, which is conservative because the current owner has renovated 9 units at a lower scope and is getting $264 premiums. We're going to a slightly higher scope, spending about $14,000 per unit on those 135 units. And we're assuming the same rent premium, which we think is conservative. So got a ton of upside. Like Sarah said, it's a 6 cap, which feels really good.
Oh, yeah.
And it feels like we're buying at a high cap rate. I haven't bought a 6 cap, guys, since 2017. Okay. So that's a very, very high cap rate right now.
Mm-hmm. Oh, I think it's awesome. I'm totally excited. And so I put the link in the chat, and if you put in your name, your email address, no, this is not binding. This is just so that we give you access to the data room, and what the data room looks like is this. So it has all the details that Shakti just mentioned. It has a video that they took video with drone and interior to show the business plan. It's only like 2.5 minutes. So it's really easy to get a high level overview. And then we'll automatically, anyone who registered for this webinar, we will register you for next week, where we do the business plan webinar. We'll actually walk through the deck. You can see here, there's 3 investor classes. It's a little different than what we've seen before. But class A, an investment of $1 million or more, there's a 16% preferred return. That is very generous. I love it. I love that for you guys as investors. And there's a 60-40 split of profits, meaning investors get 60% of the profits after that 16% preferred return. For class B, so it's an investment between 250,000 and $1 million. You still get the 16% preferred return, which is really generous. And then there's a 50-50 split on the profits after that. And then anyone else who comes in under the 250 mark, you still get a 12% preferred return, which is like amazing. And a 50-50 split of the profits after that. So really the hurdles are around the preferred return in my mind. And they're all going to be a target of 18 to 21% on the annualized return at exit. So I think it's really juicy returns. And you know, that's always what we're looking for you guys. If you jump in here, you can see all the details. And then also in the documents tab, there's the full deck that is like 75 pages of beautiful pictures of the property, all the financial details that Shakti hit on, you know, what are the expectations for rent comps and, you know, the expenses and all that kind of stuff is in there. And then all the legal docs are already in here if you want to start working on reviewing those. And then you can bring your questions next week when we have the property webinar. So any questions on that? I see a bunch of people who put in their email addresses in the chat. Does that mean, I'm not sure what that means, but if you guys want to ask any questions about the property or any questions about the data that we talked about, we're at the top of the hour, and I think we can stay another 5-10 minutes and answer any questions. There, let's see, the Q&A, we've got 6 questions in there. Let's see. Okay, this is an interesting one. Are you able to stay a couple more minutes, Shakti, or do you need to run?
Yeah, I'm just texting my meeting telling I'm running a few minutes late, but
okay,
yes.
I appreciate it.
This is super important.
I think this is a really great question. This is Agnes. I hope I say your name right. She said, Shakti said that prices are 30% off. I am only seeing 10 to 15%. And so she said, is that a Dallas thing that you're seeing 30% off on prices?
So I'm talking about 30% off, Agnes, from peak pricing. So when I think kind of where the peak pricing was, I'm looking at that, you know, price per unit that I showed you guys earlier. Let me just pull it up here. So this chart here, you know, when I'm saying peak pricing, I'm comparing peak pricing right here, 193 per unit, and I'm comparing it. This is again the national average to 155 per unit. So in this chart, it's showing about 20%. This was probably done in beginning of 2024. That's when this chart was pulled. And just over the last month or two, as we've sort of entered into those sales where there's, you know, full equity wipes, this number of 155,000 per unit is actually come down probably a little bit closer to 140,000 per unit. So like we said, you know, this is a 5.5 cap. We're buying a deal right now at a 6 cap. So that's kind of where we're seeing that that delta here in the DFW metro. I mean, look, I'd like to tell you that I get all the best deals. It's just not true. we pay a market price. And yes, sometimes we get deals that other people don't get to see. And sometimes we pay 5,000 a door less or 10,000 a door less than it would be if it hit the market. But in the grand scheme of things, we're basically buying a deal that was sold in 2024. And so much of this market isn't about, I'm getting the best deal in 2020. You get the best deal you want in 2022. It doesn't matter. If you pay 10% more for a deal in 2024, you're going to do 100 times, you're going to do a lot better than if you bought the best deal in 2022. So much of this is market timing. And we are starting to see 30% increases. During the GFC, great financial crisis in 2008, we saw prices down 50%. We're not seeing that because there's still liquidity in the capital markets. And there's a lot of capital out there. So we're just starting to see these 30% in reductions.
Awesome. So I had to see some people asking, how do we get access to the data room? If you guys see, I just put the link in the chat, and you click on it, you put in your name and your email, and then on the back end, you get access to the data room where you can preview the deck, the video, the legal documents, and then we'll invite you. It's next Thursday, 10 a.m. Pacific. Is the time when we're going to walk through the full business plan and talk about the property. But if you click in the chat right now, put in your name and address in that lead intake form, then you'll get access to the data room so you can review it all ahead of time so that then you can come prepared with questions. Here's a great question for you, Shakti. Can you talk about, I'm going to expand on this for you, Raj. So depreciation, pending legislation changes. And I'd like to hear your opinion, with the upcoming elections this year, how you think any changing legislation, don't know why I'm having trouble with that word today, that comes out of it, how will that affect multifamily? Or is there anything you think that will come out of it?
Yeah, I think there's a couple things that impact multifamily. Obviously, interest rates, guys, we've already talked about those, and taxes, right? Not just property taxes, but estate taxes, depreciation. There's the Trump tax laws are beginning to phase out right now. They're also talking about potentially getting rid of the 1031 right now. They're talking about changing, making adjustments to the rules on basis and step-ups in basis when people die, which is an estate tax issue. So there's a handful of different items there that are coming into play. I don't want to say who I'm going to vote for and why I would vote for that person, but I certainly think that depending on who becomes the president, there could be an impact on taxes for sure. If Trump gets reelected, he's going to obviously expand the Trump tax cuts. Right now, we're beginning to phase out those depreciation schedules. I think this year we're at 60%. Obviously, there's legislation in Congress to retroactively get depreciation back to 100% for 2023 and 2024 and going forward. That hasn't been passed yet, but of course, it's an election year, so things are moving a little bit slower on that side. But I do think, depending on who becomes president, the 1031 law could be impacted. And they've been trying to talk about getting rid of 1031 for a long time. It would take a big push for that to happen. So I don't know if that would change necessarily, but there's talks are starting again. But I can tell you the depreciation, I think for sure, if it doesn't get changed this year in Congress, the election next year could have an impact on which direction that goes. So for what that's worth.
Thank you. Toby says, I've heard a lot of explanations of cap rates, but that one was the best.
I tried to explain it. I confused myself a couple times while I was explaining.
No,
You got it, Toby.
Yeah. Toby is also asking, is this new investment 1031 exchange eligible? This one is not, Toby, but we're looking into having the next one eligible for a 1031 exchange. So if you want to give me an email and shoot me an email, and we can talk about the timing of your exchange and the size of your exchange, and we can see what could be a good fit for that. And that goes for anyone else in here. If you're selling property and you want to move from being active to passive, and you want to go into a syndication or a property that's managed by one of us, as you sell your property, shoot me an email and we can see if we have something that fits as far as timing and dollar amount, because we need to make sure that it works, as far as the debt you need to assume and all of that. Yes, Gary, you do need to be an accredited investor for this next investment. And then Shakti, we can take this as the last question today. It's a big question. Please discuss risks in current AG portfolio financing and any possible destabilizing on financial health of AG.
So this is a great question to end on. So obviously we bought deals at the peak of the market at the end of 2021 and first half of 2022. And like I said at the beginning of the presentation, 10% of life is what life gives you, and 90% is how you react to it. So we've been extremely proactive in terms of controlling the things that we can control. We can control the operations. We can control how much we're pushing rent, the type of rehabs that we're doing, our occupancies, how we're dealing with lease exposure, how we're dealing with expenses. We can fight and litigate property taxes, which we do every year. We can get creative with our insurance, which we did this year. We put everything under an umbrella and put it under a $1 million plus aggregate, which actually lowered our rates pretty significantly. So we can control what we can control. What we can't control is interest rates. And we worked off of what the Fed told us was transitory inflation at the end of 2021, and then they began hiking rates in March. So we can't control that, but what we've done is proactively engage with our lenders. We've created a debt fund vehicle for our investors to put capital into that has a current pay vehicle, which we'll be talking about, I'm sure, with you guys at a future date. But we've come up with the creative structure to get our investors to get more capital into the deals so we can sort of ride this out. The capital is not for CapEx. The capital is not for operations. The capital is for rate caps, which, as we know, are very expensive right now. And our investors understand that. They know we're local. They know we're vertically integrated. They know we're operating the deals as tightly as we can. But just mathematically, it's not possible to outrun the cost of interest rates going up by 500 basis points. So yeah, we've been creative. We've gotten a great response from our investors. Everyone's going to put in the money, and they love the solution in terms of structuring that debt fund to get them into it. So that's kind of where we are from a financial health situation. All of our other deals are fine. It's just those few that we bought during that peak time.
Yeah. As with most, folks, and then Ashland Green is being very creative, and so you're able to help the investors keep the properties, unlike some of the other operators, which you're able to purchase from at this time.
Yeah, and look, like we're blending that new money with the old money, and they're still getting a return on their investment. Slightly below what we projected in the pro forma. We projected a 195, but we're delivering close in some deals a 170 to a 180 over a slightly longer hold. So I think they appreciate our approach, patient, prudent, thoughtful, and they know we're executing. So I think they're comfortable continuing to partner with us. Yes,
I love the solution.
Thank you.
Well, Shakti, I know you have another meeting, and audience, thanks for being on for over an hour. I hope you found that really helpful. We will send out the recording today, and know that you can share it with anyone. I'll put it up on YouTube if that's fine with you, Shakti, so that it's really easy for folks to share with anyone that you think might be interested in real estate and markets and looking at it, the data and not what's going on in the media. We'd love for you to share it. And again, we'll see you all next Thursday at 10 a.m. I'll invite you. Shakti and I will be doing the business plan presentation for the property that we touched on today. And if you have any follow-up questions, feel free to reach out. Shakti, thank you for your time. I love your really methodical and data-driven approach to acquisition and disposition, solution-oriented. And I appreciate that you're running a team of 170 people, and you made time to be on here for an hour on a Friday and, impart your wisdom on us. So thank you.
Yeah, thanks for having me, Sarah. Always great to see you and hang out for a little while with you and the investors. Appreciate it.
Yes, awesome. All right. Have a great weekend, everyone. Bye-bye.
Thanks, Sarah. Bye.
Bye.